Thanks, everyone for joining us today. And in fact, it's a good day to get into a call on market update, seeing the way markets move today. But there's going to be some daily changes and on every day. So let's not take this as a precedent. But nevertheless, let's broadly understand as to where the markets are today, especially in the kind of volatility that we have seen. So while we have seen a relief rally today over the last 1 month, but there has been significant correction or volatility that we have seen prior to that. So let's first understand what led to that, what's the current situation, and in these uncertain times, how are we placed and how are we positioning the portfolios. Coming straight to the point, this is what the market broadly looks like. This is slightly dated, about more than a week old data because the numbers keep on changing. But broadly, as you would have all assumed, 1 year returns for Nifty have been flattish, slightly positive now after the move that we have seen in the last 1 week or so. Large caps have slightly outperformed mid caps. The same number a year back would look that India would be among the best performing market or the top three performing markets, but not in the last 1 year. You see European markets, Germany market, US markets, Singapore, Hong Kong, China market, they've all done better than India. So we're still above mean or say uh, in the better half, but not in the top quartile the way it used to be. What are the worries? The worries is obviously we all know we have been discussing this since months now about the tariff, the Trump tariff, and broadly the volatility that we have seen. We feel it's not just Trump. So most of the people or most of us believe that Trump is the reason behind the volatility. It is not the only reason. Trump was mainly a trigger. Uh, there were two factors to this. One was that the growth rate in India was slowing down, and that also had a reason for the volatility that we saw. What you see on the screen right now is the quarterly GDP numbers. Second quarter of current year, the GDP was 5.6, which was a 7 quarter low, right? And these numbers are low because they are coming on a high base. So if you see effectively after a long period of time, we saw this number, which was 5.5, 5.6% GDP, which was pretty low considering the way India has been growing and considering the way we have been positioning ourselves, right? So what was happening was the expected growth pickup in India in FY25 did not happen. In fact, there was some deceleration. When these numbers was declared in the second quarter, market momentum was good, liquidity was good, sentiment was good. The people did not pay much of attention to it, or there was no, you can say, discussion around it, much of discussion. People thought, yeah, it's just a passing quarter, things will recover, kind of thing. And nobody was too worried. In this backdrop, when the growth rate was slowing down and the market was still rising and the valuations were full, we were like almost 10% premium to the 10-year average. So though we are not over the top, but yeah, we are above the 10-year average. And hence, market was shaky, valuations were full, and that was the backdrop. And then the Trump tariff issue came in, and this was the trigger according to us. It is not that just because of Trump things have gone bad. It is just that the Trump is a trigger. And when the tariff issues came in, if you see the numbers, most of the markets would have declined. You see, including the US market, they all gave you a negative return because of the Trump tariff uncertainty. So, what is this uncertainty and why are people so worried? Especially because in the first term also, Trump had mentioned that he'll have tariff, he wants to move manufacturing to US and whatnot. And this term also he's doing the same thing. In fact, if you have to look through, Trump is saying exactly what Modi has been saying for India, which is Atmanirbhar Bharat, make in India, reduce import dependence. Trump is also telling you the same thing that I want to make manufacturing in US, make US great again. Why should we keep on importing? We have a large trade deficit. We should reduce that and improve manufacturing plus employment in US and whatnot. The difference being Trump wants to do it overnight. He wants to do it via very, you can say, strategic moves of tariffs and very bold moves of tariff. Modi has been doing this over the last 10 years now, right? And we have been gradually doing it. But the thought process is exactly the same, and there's nothing wrong in this thought process. Then why is the market worried? The market is worried because initially it was felt that the US will have a 10% kind of a tariff. And then when Trump came in, he said, no, it's tariff is not going to be 10%, it's going to be 30, 40, 50%, which was what spooked the markets. People felt he's just going to talk about this and negotiate later. But when the date came in, he came in and announced that no, this is what the tariff is going to be. And that is what just spooked the market. That no, this guy, uh, whatever word you use for him, he is going ahead with what he wants to do, and there's going to be a significant tariff. That spooked the market because ultimately, by having a very high tariff and expecting companies to follow that overnight, then you're importing inflation. So if there's an effective tariff of 30-40%, which means that anything and everything that you import is going to be 30-40% more expensive, and effectively that is what is going to be the bill that the consumers will have to foot, and that will impact the demand. If today you're consuming something at 100 and that become 120, obviously if you're earning 10 units of that product, you're now going to use 9 units of that product because it's got more expensive, right? And that's going to impact the demand. This led to global volatility because US market started to correct because of that. So till 10% was fine, but when they realized, well, no, it's not just for negotiation, it's going to be 30, 40, 50, 60%. Plus, China also retaliated. And that's going to be obvious, right? It cannot happen that Trump comes and tells India or China or whichever country that from tomorrow you have a 50% duty, and the other country will say, okay, thank you, and sit down. They're going to retaliate, right? In whichever way. Maybe physical restrictions, counter tariff, currency devaluation, or something else, right? We don't know, but people are going to retaliate. So this is what the backdrop was, and that's the reason markets turn volatile because the US market itself corrected because there was a fear of demand slowdown there. This was the scene in Jan, Feb, maybe till mid of March something. Then came the date of April when the tariffs were going to be effectively launched or effectively implemented. And that is when Trump came and said that now there's a 3 month deferment towards this. And to start with, there's going to be just 10% tariff. This was looked like a step back from US because prior to that, it was like, okay, US is putting tariffs, China is putting counter tariff, and it was like a Me Too kind of event which was going on. Once people realized that Trump is taking a step back, they felt that the old assumption that this is more of a negotiation tactic and the final number is going to be significantly lower than what he has been stating is when markets started to see a relief rally. And this started from the first week of April. Markets were oversold, people were in worry, they were in fear, and hence there was short covering, technical buying, things started to move up, and things started to revive. This is what happened. As we enter the scenario today, in fact, today's morning, India time news is that the first round of talks between US and China have resumed, and they have reduced the tariff they have imposed on each other from whatever 130, 140 number to a more manageable 40. And now they're going to work further towards this and bring it down to a respectable level. So this is broadly what the scenario today is. That the latest scenario is that the talks with China has also resumed, and as a precursor to the talks, they have got down the tariffs to a more manageable number. And that's not going to be the final number too. Its final number is going to be mostly lower than what they are going to do. So in this backdrop, how is India stands point? Today, effectively, India has a 10% duty, like all other countries. It was proposed to be 35-40% duty. But the good thing about India is that one, export as a percent of GDP is not even 5% for us. We are more of a domestic conventional economy, and the peer group, the neighboring countries or the Asian countries or whomever we compete with in the export market, the duty structure on them is higher than what is there in India. So China, Philippines, Taiwan, Malaysia, all of these countries have at least proposed tariff number which is higher than what the Indian number is. And hence, on a relative basis, India is much better off. We have been in a decent scenario where because the major export for us is pharma and IT, which is you can say more resilient and better place than many other sectors or many other products or commodities per se. And that's where the backdrop is. So India on a relative basis is doing well. Now, this is what was the global issue, and this is how we are placed. Coming to domestic issues, which was this slowdown, we feel that the main thing, which was the issue, which was the slowdown, the worst is behind us. And why do I say that? I say that because of three reasons. The slowdown happened because one, the middle class or the lower middle class in India was consuming less. The higher inflation was impacting the demand. Second, government spending was low. There was elections, bulk of money went towards elections, and then we know that there is a code of conduct 6 months before elections, or when the date is announced, you can't make any new orders, you can't give large payments, and everything comes to a standstill kind of a thing. And third, the private sector capex in India was not recovering, right? This is where the backdrop was. Now, as things stand today, the government has effectively addressed all these three concerns for the economy. And how is it addressed? First thing, consumption was slowing down. Government gave you a tax break, which is effective from the current month or say the last month of April. And all salaried guys or any tax paying guys will have more disposable income in their hand because they are going to pay less tax. Now, this money is going to get spent. Somebody will buy a bicycle, somebody will buy a two-wheeler, somebody will buy a car, or somebody will decide, no, I don't want to spend. He'll go and save this in his bank. And if he does that, and if he creates an FD, the bank is going to lend this money to somebody else who is in need of it. And hence, effectively, if you are not going to spend, the bank is going to spend on your behalf. So net, there is going to be a domestic demand getting generated because of the higher disposable income that is going to be there. So we are expecting recovery or revival in demand based on the tax base that I've seen, and hence the consumer demand should start to pick up. The second point was government spending. As we speak for the quarter, Jan, Feb, March, the government spending has recovered. Government has clearly realized what was lacking. The order activity has also picked up, and hence that issue is also not no longer relevant. So this is broadly what you see. This is what the cumulative growth is. So this is a Jan number. The Feb and March number are also higher. So what was negative because of the election has also started to pick up. The third thing was the private capex, and this is what has happened. We have already seen two rate cuts coming in. We have seen various OMO measures that the government has taken or the RBI has taken to infuse liquidity, and today we are sitting on liquidity surplus. Now, because of this liquidity surplus, it's a clear indication by the government to the private sector that now rates are lower, there's ample of liquidity. Just borrow or use this money for your working capital, capex, or whatever requirement you have, and hence things to start to look up. So the three issues that we had, all these three issues have got addressed in a way. The even icing on the cake is that government has said that this is what they have done so far is just round one. If this round one is not sufficient, then they are okay, or they will definitely consider doing a round two if required, which means that the government has clearly realized what the issue is, and the focus is very clear that they want the growth rate to pick up, and this is what the background is, and hence we are pretty confident that things should start to look up, and it has already started to look up. Second quarter was 5.6, third quarter was 6.2. Fourth quarter is going to be 7 plus. If the full year number of GDP needs to be achieved, which was just shared in the month of Feb, then the fourth quarter number has to be 7. So 5.6 going to 6, 6 going to 7. So things have started to look up. So now this is the setup. Domestically, economy is reviving. Growth rates is picking up. Not that we were negative growth. Decelerated growth is now started to look up. It's not going to be a sharp V-shaped recovery, but things are starting to look up and worst is behind us. Globally, we don't know. There's still some uncertainty, and that uncertainty stays. And what that uncertainty now is that while we all know that Trump is negotiating, what can go wrong on the global front is what the worry today is. And what is that worry? That worry is this. When Trump administration came in, they thought a 10% tariff can be worked or can be handled by a simple way that 3 to 5% the dollar will appreciate. So that will negate the negative impact of tariff. 2 to 3% the exporting country or company will sacrifice the margin. So say if today Infosys is exporting something to US and earning 20% margin out of it, Infosys in the post-tariff era will be okay to earn an 18% margin and give a 2% benefit to the buyer in US. And the balance 2-3% impact, net impact to the end consumer in US can be negated by giving them tax break. By putting a tariff, there is going to be additional income for the US government, which they'll use to give tax soaps to both the corporate as well as the retail in US, and hence the whole impact of a 10% tariff can get negated. But as things stand today, things are not as simple as what Trump would have imagined. The dollar which was appreciating, the blue line here that you see, the dollar which was a dark blue line that we see, the dollar which was appreciating, and this is the light blue line is the dollar index, which was 103, 104 when Trump came in, went all the way to 111. But as we speak today, it is below 100. So effectively, the expectation of 4 to 5% dollar appreciation has not happened. In fact, there's dollar depreciation, which means that whatever US is importing right now, it is paying more because the value of dollar has gone down, right? So instead of benefiting from a dollar, you are negating from the currency. Second thing is your biggest trade partner is China. And on China, you still have a higher tariff. Even after today's announcement, there is 40% plus tariff on China. For other countries, 10%, right? And China is your biggest trade partner. So unless and until you settle soon with China and get into a respectable number, the inflation impact of Chinese imports, which is your biggest partner, is still pretty high. Imagine you're buying something from China at 100 rupees in the post at 40% tariff. Now you're going to buy at 130, 140 rupees, right? It's a decently, it's a very high price impact that one has to see. Because of this, the uncertainty and things not working out, people in US, both corporates as well as citizens, have deferred their decisions. Now imagine if you're a US customer or you're a US citizen. You said that, oh, I wanted to buy a car, but I don't want to buy it today. I'll wait for 2, 3 months. I don't know after 2, 3 months what will happen, whether Tesla will get expensive or cheaper, or a Chinese car BYD will get more cheaper in US, or whatever else happens, I don't know. Let the dust settle down. If I have to buy a home, I don't know where interest rates are headed, because if inflation is going to be high, interest rates in US are going to be high. Tomorrow, if the inflation outlook changes, then the Fed is going to cut rates, which means that your mortgage is going to get cheaper. So I'll wait for it. And hence, economic activity has kind of slowed down in US, and that is reflecting in the stock market. So what bounce back that we see in markets is predominantly that the news flow is now turning positive in the global front. That okay, Trump is negotiating, he's okay to talk, he's realizing that no, he can't sustain a 30-40% tariff, and that's where the things are today. And that is what the uncertainty is. That what could be the demand destruction in US. Specifically to India, we had the geopolitical issue which came in. Markets didn't react too much negatively towards it, feeling that this is not going to be a very long run affair because Pakistan cannot sustain a long war because it doesn't have the financial strength to do that. At the same time, there's too much of international pressure also on Pakistan because obviously what has happened, we all know it's been unfair, it's uncalled for. So markets didn't react much towards it. And once that call that it's going to be a short-lived thing uh, became true over the weekend when there was a ceasefire, we saw a good short covering come relief rally come whatever cash deployment and incremental buying or whatever it is, a combination of all this put together, which came in today. And we had a very sharp gap up opening as well as a continued buying coming in there. So I believe at least in the near term, the geopolitical issue is now in the price. It's not going to much happen even if the ceasefire gets violated, unless and until there is something which is major happening at either side of the border. Markets are not going to get too worried per se. So at least for now, the risk of the geopolitical issue is lower. The risk today market is of global only as to what could be the demand destruction in US. There could be news flows which could be positive because today we are assuming China has a 40% duty. After talks, maybe after a week or maybe after a month, we decide okay, we settle at 20% duty. The way India and UK FTA treaty has got announced last week, similarly India and US are right now on the discussion table, and that treaty too can be decided as soon as a week's time or 10 days time. So that's also something which is going to be incremental. So net, this is what the thing is. Domestically versus behind us, things are looking positive. Relatively, India stands out. Currency has done well. Our forex reserves are good compared to other markets, compared to other currencies. We have done much well, and things are looking better for India. Coming to the FIs, who have been net sellers for a long period of time, especially the last year, we have seen in the current calendar year, FIs have come back. Last year, when we used to have this call, then we have to this discussion, we used to always tell people that we don't expect FI selling to continue for long. They will come back, just that they are booking profits, their house in FI, or there was a trade where people were moving assets to dollars because it was expected the dollar will appreciate, and it had also appreciated. 103 had gone to all the way to 111. So FIs had sold not just from India, they had sold across markets, across the emerging markets, and hence India was also part of that market. Whatever number that we see that they sold billions of dollars, it is true, but it was not even 3% of the holdings, right? Which is minuscule, which is nothing else. You have 100 rupees of assets in India, out of which you have booked profits or sold only 3% of that, right? So it's not an alarming number. But yeah, they have been sellers, but the good news is that they have come back. Why they have come back? Because relatively India is better position, both on tariff, both as an economy, which is a domestic demand driven economy, strong leadership, things are looking good, and hence, and worst is behind us. So all these factors put together, we have seen that net in the month of March and so far in April, we have seen net buying coming in from FIs also, and domestic liquidity remains strong. So this is what the backdrop is. For us, inflation is also broadly in control, because of which one can expect maybe another 25 bips of rate cut, maybe not immediately, but over the next 6 months or so, once the global dust settles down. And the other benefit that India is now witnessing is this crude, which used to be as high as 80, 90s just recently. Now, as we speak, is around 60 levels. And as we all know, that's the biggest import bill that we have. So this is where things stand today. This is what the market valuation is. We are now closer to 18, 19 times 1 year forward, which is where the market is. A few months back, this was a 10% premium. Market came off, it has recovered, but the valuation has not recovered much because over this period of 6 months, there has been earnings growth in India also, right? So even though the growth rate has slowed down, there's still a decent double-digit earnings growth in India, and hence valuation is now still reasonable. And that is the reason FI interest is also coming back to India. So we are decently priced, or we are at a decently priced markets as we speak. Sectoral wise, also wherever there was heavy fraud, like capital goods, or say to a certain extent pharma, to a certain extent consumers here, those valuations are also kind of settled down. So we are, most of the sectors would now be closer to the historic averages or near the mean. Some sectors will stand to benefit, like a pharma or something which is still higher. And this is broadly how the sectoral performance has been. If you see over the years' time, Bank Nifty and Pharma have done the best. And what has not been so well has been the real estate sector, this is the consumer sector, right? On the fringe, the high frequency data that we see are also looking up. You see the GST collection, you see the energy consumption, they all started to look up from the numbers that we had. And that also gives us confidence that uh, the worst for India is behind us and things incrementally will start to look better. So net, this is what broadly the market looks like to us. Because of tariff or because of global issues, there's still some uncertainty because we don't know how the global markets will react once the dust settles down there. Right now, they're also witnessing relief rally, and that is the reason that Indian markets also have done relatively well. But from here on, I expect markets to function more depending on how the global markets are. The geopolitical issues now behind us, start to again not mirror, but at least trend wise track global markets. So if tomorrow for some reason the US markets were to correct 10%, maybe for whatever reason, Indian markets will also fall, not to the 10%, but maybe 5, 6, 7% kind of number. If US markets were to rally 5%, we will also follow the global market and we can also rally 5, 6, 7%. So on a relative basis, India will be better off, though the direction can be similar to what the global markets are. So it can't happen that the global market is down 10% and India is up 10%. Right? That won't happen. Yeah, we will fall less than what the global markets are for the obvious reasons that we have. And it's a reasonably priced market. Let's be very clear, it's not a cheap market. Right? In this fall also, what has happened is in the Jan, Feb, March correction that we're seeing, a 60p stock has become 40p, or a 40p stock has become a 30p stock. 30p is still not an entry level P. So if you want to buy a stock at 30p, market is cheap. It is fairly priced. you have to hunt for value. You have to hunt for a good investment idea. You have to hunt for companies where your risk reward equation is favorable. In this backdrop, we expect as things starts to improve up and globally things settle down, the momentum will be back in India, and over the next 3 to 6 months is what we feel there will be decent clarity. People ask us as to what in this backdrop, what should one do if somebody wants to deploy money? How should one look at these markets? Or if somebody wants to say book profits or maybe move cash somewhere else or have some other recommend, what should be one doing? Our general advice is that it's better if we stagger our inflows over the next 3 to 4 months. Start investing right away. Don't wait because as we have seen, market falls equally sharp and it recovers equally sharp. So start investing. Don't wait for it, but don't come in lump sum. Come over the next 3 to 4 months. I'm not saying do everything at once. IPO. Why the next 3 4 months? Because whatever is going to happen globally, good, bad, or ugly, or if there is going to be round two of tariff wars or of talks falling between US and China, that can also happen. Today we accept that the US and China are talking. 2 days later, there could be a press announcement saying that no, we couldn't reach to a conclusion or we couldn't reach to a you can say mutually agreeable number, and hence we are going back the way it happened between Ukraine and US, right? Something like that. It can happen. Or the way it happened between India and Pakistan, there was a ceasefire, but the very next few hours later, there was violation of the ceasefire, and the next day again there is ceasefire, right? So these things will bound to happen. So whatever good, bad, or ugly is going to happen globally will happen over the next 2 to 3 months. We'll have a better clarity, if not complete clarity, in the next 2 to 3 months. And the recovery in India also will be much more visible over this period, and hence one can take advantage of this global reason. And why should one take advantage is because domestically India is doing well. Had it been a scenario we also not doing well and globally also not doing well, then there was no case to invest into equity that is in the near term. But since we are doing well, it is only the global which is the issue. I feel that one should be looking to deploy capital. Yes, it's a fairly priced market, and hence don't expect a similar return what somebody has made over the last 2 to 3 years. Post-COVID, especially, it was a great bull market. Uh, Markets are pretty cheap at that point of time, and hence there was enough scope for re-rating, and the market delivered a very strong number. Mid and small cap schemes would have given you a CAGR of 30-40% return. So that looks unlikely, at least right now. But a decent double-digit return is still possible from Indian equity because that's probably what the corporate earning growth in India is. Whatever the number is, 7% GDP, 7.5% GDP, we have 5-6% of inflation. The nominal GDP in India is growing at 12-13%. Earnings growth is higher than that because there's also a big trend which is there in India is where the informal or the parallel economy of India is losing market share. The formal sector of India is gaining market share, and that is also helping the, you can say, corporate earnings growth in India. And the good thing is the stock market represents only the formal economy of India. Cash parallel economy in India is not representing the stock market, and hence the earnings growth of stock market is going to be good. And that is what we feel will be reflective in the market returns also going high. That's broadly what the scenario today is. Coming to our funds and what have we done over the last few months, how have been we navigated or tackled this volatility. Few things that I would like to highlight here is that in the month of Jan, Feb, we have not done any major activity in the portfolio, either buy or sell. Market was pretty volatile. It was not very clear about how things are going to be. And we thought that it's better not to do any major activity because whatever we do, buy or sell, we'll be taking more of an emotional decision than a rational decision. And hence, better to wait it out and then take a practical and rational decision. On the fringe, whatever small buying sign that we wanted to do or fish in the portfolio that we wanted to do, we continue with that. But no major activity happened. In the month of March, end of March, early April, we deployed some of the cash that we have. This cash was strategic cash that we have at any given point of time. We have 5-6% cash in the portfolio. Right now, uh, also we would have having 5 to 12, 13% of cash into the portfolio. So we have gradually deployed this cash in the portfolio in the month of April. Second half of April, we are not done much activity. We have done some activity in the month of May. it is banking sector related rally. But yes, market moved up pretty sharp, and hence we waited out for the thing. And then the geopolitical uncertainty came in, which now, in fact, today there's some clarity on that, right? So it's been pretty difficult. In hindsight, it would look like, oh, in the month of March, we should have deployed all our cash. Market has saw such a sharp rebound, or the market was falling. It should be the right time. This is all in hindsight. Today, because of this uncertainty, you cannot take a very bold decision, or you cannot take a very aggressive decision, buy or sell either way. You cannot even say that, okay, I'll sell and have a 20-30% cash in the portfolio. Imagine what would have happened seeing the rally that we have seen in April and what we saw today. At the same time, we cannot say that, oh, let's just buy everything, because you don't know if the ceasefire wouldn't have happened and the border, you can say, also, then markets today would have been down at least 2% versus the 3% rally that we have seen, right? So it's very difficult to take a very aggressive call in such certain time, and hence we also have been gradually deploying our cash. Where has this cash gone? It has gone predominantly into financials. We already had a decent financial exposure. We added more towards that. We added some chemical names, we added some pharma names, and on the fringe, we would have, say, divested some of the stocks where earnings visibility had reduced or valuations are getting full. So we would have trimmed or booked profits in some of the telecom holdings that we had, where we booked some profits. We booked profits in IT, some of the IT stocks that we had, especially the large cap IT that has done well. We booked some profits there. We booked profits on some of the metal holdings that we had, and we moved that money to other sectors. Going ahead also, the view remains that we are neutral on IT. We are positive on financials that we feel we should continue well. Chemicals is looking interesting. That is where we are looking to add some exposure over the next 1 to 2 months, because globally now India is gaining market share in chemicals. And if somebody has to, whatever the tariff is, it's going to, China is going to have a higher tariff than what India is. And hence it's a fair possibility that we'll have a market share gain versus China. And that's the reason we are looking at this sector. EPC sector is looking good because government ordering, tendering, and execution has started to pick up. So that sector is also looking good. Cap goods, we are neutral unless until you find something which is very compelling. The big known names in cap goods, ABB, Siemens of the world, they all still trade north of 40-50p, and hence we are not very interested to invest in those valuations. Same thing is true with consumers. Consumer staple is still expensive. Consumer discretionary, you have to pick and choose as to what you like. That is what portfolio. What you see on the screen right now is the all cap portfolio, which is a combination of large caps and mid caps. So at any given point of time, this portfolio have 40 to 60% large caps and the balance on the mid caps. What you see on the right is the top holdings of this portfolio. Known names, more of financial names, and maybe some of the obvious popular names are not there. Maybe like a Infi, TCS, Lever, ITC, Bajaj Finance, or like that, because we like these companies, but not at the price at which they trade, right? So we want to be value conscious while we are investing. So we are not blind quality buyers. We are quality, but not at any price, right? So because of that, if something is too expensive or the valuation comfort is not there, I'm happy to be a consumer of that company rather than being an investor of that company, right? So this is what the portfolio looks like. Fairly diversified across sectors, as you see on your screen here, and it's that we have. The other, these are performance numbers. There's a small drag here in the 1 year numbers, especially because we have lost over the last 6 months volatility, and we hope to cover that when the market stabilizes. And this is what the portfolio composition right now is. We have close to 8-9% of cash, almost 50% is large cap. The balance would be mid caps and some small caps or smaller mid cap kind of exposure that we have. In spite of this 1 year drag since inception, it's been a decent outperformance that we have been able to achieve. The other portfolio that we have, which is the emerging opportunities portfolio, which is a dedicated mid and small cap portfolio, something similar. Uh, this is what the top 10 holdings are. Many of them would be known names or market leaders in the respective sub-segment that they have. For example, the PNB Housing. It's not a top financial institution, where it operates, it is among the top five. Or say Federal Bank, among the mid-sized bank, Federal is among the top five. Or Max Insurance, it is not India's largest insurance, but yeah, there where it is. And this is broadly what the portfolio is, which is also fairly diversified portfolio. Coming to the numbers here also we have a 6 month drag, but in spite of that, 1 year numbers we are still outperforming the markets overall since inception. It's still a pretty strong alpha generation that has been able to achieve so far. 60% is small cap exposure here, almost 30% is mid caps, very small, large. That is also a larger mid cap than a large cap, and some 7-8% of cash. People to ask us this question, and that mid and small cap have done very well, and it's obvious in the last 12 months large caps have started to do well. Why then one should look at this portfolio? Why should one exposure in this portfolio? Two, three things. While it is true that large caps have done well, and in the last say 12 months or so, or 8, 9 months or so, every strategist or everybody whom you would have met would have said that now large caps will do well because for the last 3 years mid caps have done well. What they are saying is exactly like a mean reversion, right? Everybody knows what the mean reversion is. That doesn't mean you change your strategy. We want to be disciplined in our approach towards investing. Each portfolio has a strategy, each portfolio has a theme, and we would like to stay to the theme. At Abacus, we never have this discussion that whether we should buy large cap or mid caps. If it is a mid cap fund, it will always remain a mid cap. It is a large cap fund, it will always remain a large cap. Within large caps, we want to find the right value, the right stocks. Within mid cap, we want to find the same. So we don't get into this argument of large cap versus mid cap. So this is a dedicated mid and small cap portfolio, and it will remain that. You will not see HDFC Bank coming in an emerging portfolio unless there's a Six Sigma event something. And I believe even if something like that happens, HDFC Bank in this portfolio, right? So what is mid cap and small cap should remain the way it should be. And we are pretty confident that the value conscious style of investing that we follow will be able to navigate the near term underperforming or outperform that we broadly see. Now, third portfolio that we have, which is the latest strategy that we introduced almost a year and a half back, is the diversified alpha strategy. This is a 40 stock portfolio kind of thing. Since this portfolio was in a gradual deployment mode and market was pretty aggressive, both while going up as well as going down, we have been slowly deploying cash. So this portfolio even today has a 16% cash holding. It is not that this portfolio had 5% cash and that has gone up to 16. It had in fact 35% cash, which has been gradually gone on to the 16 number. And as we speak, we are gradually deploying this cash also. So right now is pretty diversified as we have decided, but we have been slow to deploy capital because of the market uncertainties and because of the volatility. Because of this, the 1 year number is slightly drained, predominantly because of the near term, you can say, underinvestment that is going on there. And since this doesn't have a very long history, since inception also number, there's a small, you can say, drag in this portfolio, which in the next few months we think will start to recover because once this cash gets deployed and when the market stabilizes, that is the time when we make the maximum alpha. And it's a pretty decent portfolio. 60-70% of this portfolio will be overlap to the first two strategies, and there will be many common names like a PNB or a Bharti or Axis or NTPC or something like that. But nevertheless, the mid cap component of the portfolio is very different. Now we can all discuss the portfolio, what the portfolio valuation is and what is the growth in the portfolio. I can tell you that I follow a value conscious style of investing and I don't want to overpay, but then that should be visible in the numbers. And this is what the numbers are right now. If you look at the all cap portfolio, this portfolio is trading at 20 times forward earnings, which is roughly what broadly what the market is. But if you see the earnings growth is higher than what the market is. And if I have to include the financials, which is there in the market multiple, then this is portfolio trading only at 17 times versus 20 times what the broad market is. So X of financial, this portfolio is there. So this is a portfolio where the valuation is lower than what the broader market is. And at the same time, PAT good is pretty decent. The debt equity is just 0.3. Same way, if I have to look at the emerging opportunities portfolio, this is broadly what the portfolio looks like. It's trading at just 18 times X financial for a pretty strong earnings growth. This year, earnings growth was 15%. Why? Because both demand and GDP in India decelerated. And this portfolio had a very strong base year of 24 where we had a 30% earnings growth. And hence this number looks bad. But next year I expect the growth rate again to pick up, or rather in the current year of FY26, what we expect growth again to pick up. And say decent debt equity, decent growth, and a decent price multiple. The same thing is true for the diversified alpha portfolio also, similar kind of valuations and a similar PAT growth. Maybe this year in this portfolio, the PAT growth is pretty high because of the composition is different. This portfolio has everything, large, mid, small, and macro. Hence, the PAT number of this portfolio this year is pretty high, and because of that, on high base, next year I'm expecting only 14, 15 profit growth, but a decent value as well as a decent debt equity at just zero point 0.4. So this is broadly what that you can say portfolio is, what we have done so far. We have added to our team over the last 6 months. In April, Sanjay Joshi has joined us. He's a veteran. He's been with bulk of his career with Nippon AMC. We also saw over the last 6 months Ankit joining us from Kotak. He's handling the private equity portfolio that we have, and this is broadly what the investment team looks like. So whatever we have seen and whatever we have delivered is all part of this team effort. It's not just a one-man show kind of a thing. And going ahead also, as we speak, we continue to uh, build on the team, and we're expecting new additions to keep on coming in. So that's broadly what we are. I'll take a pause here. I think broadly I've covered both market positives as well as negatives, the uncertainties, what we have done in the portfolio, how the portfolio looks today. Uh, I'm sure you might have some queries on both the markets as well as on the portfolio. Maybe we can open up for Q&A now, and happy to address any questions or queries that we have. We'll refrain from stock-specific discussions. It's not allowed as per the compliance regulations done by SEBI. But besides that, happy to address any queries anybody would have. Shalish, we can maybe now open up for Q&A.
Yes, sir. So the first question is your view on pharma and healthcare as a sector.
The view is positive on pharma and healthcare for a very simple reason that one, uh, though Trump has repeatedly said that there's going to be tariff in US on farmers also, we feel that tariff is not going to be pretty anything significant. And why do we say that? Because Trump has deferred tariff of electronics for the next 3 months, right? Which means that Apple is not getting expensive, which means that your PCs are not getting expensive. In this backdrop, how can you justify that your pharmaceuticals, which is a necessity, is going to get expensive, right? Your iPhone is the same, but the medicine that you take is going to get expensive, right? So while there will be tariff, it's not going to be something which is going to be a significant tariff, is what we feel. And if it is a marginal 5, 7, 8, 10% kind of a thing, Indian companies are well positioned to tackle that. And hence, I'm not too worried on the pharma. Domestic pharma names unfortunately trade at a steep premium. They trade at 35, 40 times multiple, and that's not what our focus is. Our focus remains on companies where valuations are in the 30s, 25 to 30s P with a decent growth. And as we speak, we are gradually increasing our pharma exposure in the portfolio.
So the next question is what is the multiplier impact of tax breaks for GDP?
So it's difficult to say because, as I mentioned, the money which gets saved gets used in which form. Somebody will use it to buy a bicycle, somebody will buy a two-wheeler, somebody will buy a four-wheeler, or somebody will just save it in the bank, and then the bank will lend it to somebody else. But typically, 2 to 3x is the multiplier, because if you say, assuming you buy a two-wheeler, which means there's a higher two-wheeler demand, which means that the guy working in the two-wheeler factory uh, is going to work double shift, which means that he'll have a higher salary coming in that month, which in a way he's going to use uh, for his own personal spending and so forth. So it's a 2 to 3 times multiplier typically that we see in the economy, but that comes with a lag. It doesn't come overnight because the benefit also is going to come every month, right? So assuming you get 1 lakh rupees of savings over the year, right? Which means that every month 8, 9, 10,000 rupees is what you're going to get additionally, right? The whole 1 lakh is not going to come in the month of April.
So the next question is, what was the trigger for EU markets to do well in the early part of 2025? Trump's tariff rates were particularly aggressive against EU as well.
Yes. The reason for EU to do well was that the economy of the central banks there announced stimulus. For example, Germany was in recession. The German government and the central bank in Germany said that they're going to have a stimulus the way we had stimulus in US or UE that we used to call. The similar way, German markets announced this, UK market announced that, and for that reason, the markets which were not doing well for a long period of time, suddenly there was interest in them. So it was the way markets were in today, right? There was relief rally, there was technical rally, there was short covering, there was everything put together. Same thing happened in Europe for the long period of time, especially post the Russia issue. US markets, European markets were going down. Once the stimulus measures started announced, people or investors felt that now the growth rates will pick up. Stimulus is to generate demand, right? And once the demand comes in and the growth rate picks up, then there was no reason for the European markets to continue to languish where they were, and hence there was a rally in them. So predominantly that's the reason. Stimulus measures by the central government in Europe was the trigger point for the rally in EU.
So next question. For an investor coming in now, what would you suggesting deployment be?
So this is something which the investor has to decide. For me, I'm clear. I have three strategies. And each strategy is different, and each portfolio composition is different, and that's going to be the way it is. Tomorrow, if I feel that the mid cap will start to do well, it's not that I'm going to have a 80% mid cap exposure in my all cap. All cap will always be a combination of large cap and mid caps, right? So we are not going to change our stance. We'll be disciplined the way we want it to be. It is now up to the client. It is mathematicals that a mid and small cap company can grow faster because of the low base compared to a very large company. But at the same time, it is a smaller P&L and balance sheet, and it is much more volatile compared to a stable large company, right? So if somebody has a stomach to withstand the near-term volatility, then a mid cap over a period of time tend to do well because the growth rates there is higher and the scope of PE re-rating is also higher because large caps are all well discovered stocks. There's not much of PE re-rating which can happen in them. So that's the caveat. Um, Potentially a higher return over a period of time can happen in mid cap. It's sheer mathematics. But yeah, for that, one should be comfortable with the near term volatility. Based on that, and based on your own self assessment of the portfolio and the risk reward that you would like to get in for yourself, it is the individual client's call as to which strategy you should be looking at, all cap, large cap, or maybe a mid cap portfolio.
You on our all cap approach for next 1 2 years.
The first and foremost thing is that we are a very strong alpha in this portfolio, which has we have given away some of the gains over the last 12 months or so. We first want to regain that. How are we going to regain? We have made some changes in the portfolio. We have reduced our telecom exposure. We have reduced some of the stocks that were not doing that well the way we expected of them. And we have added more of financials, we have added more of pharma in our exposure. And this process will continue. So we'd like to uh, see that the portfolio recovers whenever the market recovers, or even if the market doesn't recover, at least the portfolio has a good earnings growth, which will ultimately get reflected in the stock price. So over the next 6 months, one should expect the alpha gap that has come in over the last 1 year to narrow, post which we should see uh, the performance continuing. So this portfolio from here on an absolute basis, if not relative basis, should continue to deliver a double digit, uh, you can say return, which is broadly what the market return that we're expecting based on the earnings growth in India.
So similar question on emerging and diversified alpha.
So emerging is doing well, though mid and small cap have not done that well, and they've been much more volatile in Jan Feb than where and what the large caps, and that is something which is obvious. But they'll also be the first ones to bounce back. So today, for an example, all mid cap IT stocks are up 5, 6, 7, 8%. Large cap IT was up 2, 3%, or consumer stocks were up 2%, banks are up 4%, right? So on a good day, they tend to recover also that way. Uh, by virtue, you should expect a slightly higher return from a mid cap portfolio versus a large cap portfolio because you're taking a higher volatility risk. Not necessarily a higher investment risk, but definitely a higher volatility risk in the mid cap portfolio, and hence one should expect a better return. So if somebody is or hoping that he'll make a 12% return from an all cap portfolio or from a large cap portfolio, you should be expecting at least 15-16% return from a mid cap portfolio. Obviously, this is over a 3 to 5 year investment horizon. Markets are not linear, returns are not going to be linear. In fact, over the next 3-6 months, market could be flattish, it could be -5-10% also, or it could be +5% from where we are. So it's very difficult to predict because, as we have discussed over the last hour or so, about the global uncertainties markets are facing. But yes, India is doing well, things are improving, and ultimately that is all going to get reflected in our stock price performance also. Hence, over a period of time, I feel a mid cap portfolio can give you a better return portfolio. The same should be reflecting in our portfolio also for opportunities. Uh, we have been consistently generating alpha over what the broad mid cap market performances, and I think that should continue. In the ADF also, the 15-16% cash that we have over the next 3 months, we hope to be 95% plus deployed. And once that is the case, then going ahead, things should start to look up.
Sir, view on consumer discretionary sector?
So consumer discretionary should do well, especially because of tax breaks. But unfortunately, most of the stocks in this sector trade at pretty rich valuations because obviously these are great companies, good brand companies, yes. And just because we are value conscious investors, we don't invest in these companies. Otherwise, these are great companies, kind of thing, right? So we like these companies, but at reasonable price, which is not the case most point of time. To give an example, say our neighbor here, Asian Paints, India's largest paint company, more than 50% market share. But for 13-14% growth, I am shy to pay 60-70p for that, right? So I'm happy to be Asian Paint consumer. I'll use that paint for my home, but I don't want to be investor of Asian Paints. I probably be better off owning a ICICI Bank or a Federal Bank or maybe an Tech or something else than own an Asian Paints, right? So because of that reason, the portfolio has less of consumer discretionary sector exposure here. Companies are good. They'll also benefit from the growth that India is going to see. So if somebody is comfortable with the companies there, he should stay invested. We have better opportunities, is what we feel, and hence our portfolio exposure is pretty low, and that's going to stay unless and until we see a meaningful valuation correction in this sector. Otherwise, we'll continue to remain share to pay 50-60p. If something comes to 20-30p, more than happy to look at them.
The view on defense sector?
Defense overall will do well, whether there is ceasefire or no. Hopefully, there should be a ceasefire because that's good for economies of both the countries. Overall, defense will do well because of the import substitution that we do. So earlier, after oil, defense used to be our next big import bill, which very clearly the government focus is to do bulk of that manufacturing in India, and hence both the government as well as the private sector is seeing good tailwinds here. The problem is again valuations in defense. So private defense companies trade not of 60-70p, which we feel is too high. PS2 companies, PS2 defense companies are bit reasonable, 30-35-40p kind of thing. Uh, Maybe around 25-30p, it makes sense to have a large allocation to them. If not, then it will be a low allocation for us. Right now, we don't have much of different exposure. We are not being a big believer or a big investor into PSU names. But post the recent volatility and correction, and like today, there's a profit booking in defense name. If that continues, say, for some more period of time, and the valuations come into that 25-30p range, then happy to look at defense also. Overall, companies will do well. Demand is there. Government is clearly focused for this, and it's a multi-year growth opportunity. It's not just 1 year, 2 year story. So from that perspective, outlook for defense is also pretty positive.
Sir, any sectors favorable for Abacus?
I mentioned that financial is still looking good to us. We've added to our EPC exposure. We have on the fringe added some of chemicals and pharma names. IT is still neutral, auto is still neutral. Oil and gas sector, we don't have exposure right now, but the way crude is, if it stays here below 60 or around the 60 levels, then uh, maybe even the oil and gas sector can come into our portfolio, which will be a low single digit, but even potentially that can come in the portfolio. Right now, we don't have exposure. Just wait for the oil to stabilize and then take a call there. But probably these are the sectors that we are looking forward.
With the AI taking center stage, what is your view on blue chip companies?
So AI is going to be part of our life in whichever way, depending on the sector and the company it is. It's like EV. It's the writing on the wall. It's incrementally going to gain market share, and that's bound to happen. Same way, the technology that we use is bound to improve. AI is going to play a role there, and some Indian companies will also benefit out of that by doing more of AI work. Many companies will benefit because it will bring in productivity also. For specifically capital markets, there are not much direct plays to play on the AI opportunity per se. We don't have any listed companies that way where AI is playing a major role, and hence not much that we can directly benefit out of it. But adaptation of AI is going to stay. That is for sure.
View on Q4 earnings?
Q4 earnings are going to be stable, similar to what Q3 earnings are. Some of the export companies will have seen a very sharp march because ahead of tariff, US companies had built up inventory. So whatever inventory many companies had in the month of March, they have shifted it. And the same companies now seen reduced demand in the month of April. So some companies will benefit for the March quarter, but otherwise March is going to be a stable quarter. It's not that we're going to see any big uh, acceleration happening in. From Q1 onwards, we should see better numbers coming in.
As you mentioned that Indian markets would follow global markets, do you suggest that if one should consider hedging and how?
So we don't do derivatives, we don't do hedging. We are plain vanilla long only portfolios. So we are not the experts to suggest anyone for hedging. Common sense is that we have to use derivatives to hedge it. It will all depend on what your portfolio and to what extent you want to hedge it. But that's the easiest and the most basic way to hedge any portfolio. We are not experts, we don't do it, so we won't be able to guide on that.
So next question, view on financial sector, private banks and microfinance. Do you believe corporate lending will pick up going forward?
Yes, corporate lending is going to improve going forward. No economy can do well without the banking sector participating. So we expect the banking sector also to participate. For microfinance also, we expect that the first quarter is going to be the worst quarter in near terms, and uh, things will start to look up post that. So the worst is behind us in that sense for the microfinance also. The high cost of credit that we saw in the microfinance sector is also going to improve as we go ahead.
View on IT sector and expectation from IT sector going forward.
Logically, IT sector should be amongst, can say, less impacted out of tariff because if something is going to get tariff, it's mainly going to be goods. It's very difficult to put a tariff on services. So the IT sector in that way is resilient. The problem the sector is facing is that of uncertainty because of which the US corporates have deferred their decisions and hence the near-term growth rates of IT sector has got impacted. Uh, we think in the next 2 to 3 months, once clarity emerges in the US economy as to where it is headed, the IT sector will perform accordingly. So right now we are neutral on IT. We have high single digit IT exposure in most of our portfolios. That should continue in the near term. We will look to increase that exposure once we see growth rates picking up.
View on Nifty for the end of the year, December 2025.
And predict that it's too difficult. Not just difficult, we are not good at that. We don't even attempt to do that. Uh,
We saw a decent rally today. Do you think this is sustainable? If not, why?
This rally is sustainable based on the news flow. News flow was positive. There was ceasefire, which both the countries initially did not follow, and then it was followed last night, and hence we saw a rally today. If the ceasefire continues and there talks and there is a positive outcome out of it, this is something which is going to sustain. Tomorrow, if there's a breach of the ceasefire, markets will give away in 1 day the half of the gain that it has uh, gained today. If we go back to what the scenario was 2 3 days back, then Nifty will be back to 21 2200 versus 24 500. That is broadly what it is today. So it is all depend on how the news flow will emerge. If the current situation stays, then this rally what we are seeing today is sustainable.
What will be the major risk, if any, from now on in this year?
The major risk is going to be global. If global markets correct, if the demand destruction in US because of tariff is pretty high, then there is going to be repercussions of that on US markets, and it will have an impact on all emerging markets also, including India. If China has to devalue its currency very sharply, then India also has to follow. We cannot have a very large currency differentials with China, right? So if China devalues, then our 84, 85 rupee also goes back to 88, 89, 90, the way we saw when the dollar was appreciating. That's going to be a risk to Indian markets. So predominantly risk is going to be global. Locally, I don't see much of risk happening in the market because, as I explained, looks like the worst is behind us and things are getting better in India.
Sir, any so that was the last question. So any final remarks from your side about the portfolio and markets?
Right. So, in fact, the last question that I answered is what the summary is. India is getting better, things are improving. The risk is predominantly global, where it's difficult to predict. We can only react. We can't preempt what the global markets are going to be or how the global economies are going to be. And that's broadly what and the risk of equity investing is, at least in the near term. But over a longer period of time, we feel equities should continue to do well. They might not do as well as what it did post-COVID because post-COVID valuations are pretty cheap. Today, it's a fairly priced market, and hence from a fair market, expect a fair return kind of thing. So, a low to mid double-digit kind of return, not linear, but over a period of time is what Indian equities can still deliver, and that's what one should be looking forward for.
Okay, sir. Thank you. Thank you everyone,
Great,
all the
thanks, Alex.
participants joining. Yeah. Thank you.